This is the story of how one of America's biggest banks became the center of a national scandal. A story involving pressure, ambition, hidden accounts, and millions of customers who had no idea what was happening in their own names. For years, Wells Fargo was seen as one of the most trusted financial institutions in the United States. But behind the polished image and successful reputation, something very different was happening inside bank branches across the country. Employees were under intense pressure to hit sales goals, and over time, that pressure helped create one of the most controversial banking scandals in modern American history. This is the Wells Fargo fake accounts scandal, the bank everyone trusted. For decades, Wells Fargo built its reputation as a reliable American bank. Customers trusted it with their savings, mortgages, credit cards, and retirement accounts. And after the 2008 financial crisis, the company appeared stronger than many of its competitors. Inside the company, executives focused heavily on something called cross-selling. The strategy was simple. The more financial products each customer used, the more profitable the bank became. Employees were encouraged to open checking accounts, savings accounts, credit cards, and other services for existing customers. Executives even promoted a phrase throughout the company: 8 is great, meaning the ideal customer should have 8 different financial products with the bank. But behind the scenes, employees say the pressure to meet sales targets was becoming overwhelming. The pressure inside the system. Former employees later described a workplace driven by numbers and constant performance tracking. Sales goals increased. Managers monitored results daily, and workers who missed targets often feared disciplinary action or losing their positions. According to multiple reports, some employees eventually began opening accounts without customer authorization. Temporary email addresses were created. PIN numbers were generated internally. Applications moved through the system quietly. In some cases, small amounts of money were transferred between accounts to make the activity appear legitimate. Many customers had no idea these accounts existed. But eventually, unusual charges and unexpected account notifications started raising concerns. Complaints reached regulators, and investigators began looking deeper into the company's sales practices. The scandal becomes national news. In 2016, the situation exploded into national headlines. Federal regulators announced that millions of unauthorized accounts had been created over several years. The bank agreed to pay major penalties. News coverage spread rapidly across the United States. Customers were shocked. Lawmakers demanded answers, and soon, Wells Fargo executives faced intense questioning during televised congressional hearings. Former CEO John Stumpf appeared before Congress as cameras captured hours of difficult questions from senators and representatives. Many Americans wondered how a respected financial institution could allow these practices to continue for so long. The scandal quickly became more than just a story about fake accounts. It became a national conversation about corporate culture, accountability, and pressure inside large organizations. The human impact. For customers, the experience was frustrating and confusing. Some people discovered unfamiliar accounts connected to their names. Others reported unexpected fees or changes affecting their credit history. At the same time, many former employees also spoke publicly about the pressure they experienced inside the company. Some said they entered banking to help customers and build stable careers. Instead, they felt trapped in an environment where hitting sales goals became more important than customer relationships. Several workers later claimed they raised concerns internally, long before the scandal became public. The story sparked broader discussions across the country about workplace expectations and ethical decision-making in corporate America. The aftermath. The fallout continued for years. Ingenuitives stepped down. Investigations expanded, and the company faced increased oversight from regulators. Wells Fargo later announced changes to its sales systems and corporate structure in an effort to rebuild public trust. But the damage to the company's reputation was already significant. For many Americans, the scandal became a symbol of how aggressive performance culture can create serious consequences inside major institutions. Even today, business schools and analysts continue studying the case as an example of how internal incentives can shape behavior on a massive scale. Ending. The Wells Fargo scandal wasn't only about banking. It was about trust. Every day, millions of people trust financial institutions to protect their money, personal information, and future plans. And when that trust is damaged, the consequences reach far beyond financial losses. Years later, the scandal remains one of the most talked about corporate controversies in modern American history, a reminder that growth without accountability can create risks for companies, employees, and customers alike. Because in the end, trust is something that takes years to build and only moments to lose.